Good morning, everyone. This session one deals with the topic of regulating earnings claims and clarifying internal consumption. We have four speakers on this panel, and in the order of their respective presentations, they are first, Dr. Stacey Bosley from Hamline University, second, Dr. Deanna Grant-Smith from Queensland University of Technology in Australia, third, Dr. Claudia Gross from Radboud University in the Netherlands, and fourth, Mr. Doug Brooks, private attorney who has dealt with MLM issues for many years. I'm sorry that we don't have the time to go into all of their credentials. I'll just invite you to go to the website and read about them. This session will run until 10:45 a.m. At that point, we'll take a 15-minute break and we'll reconvene at 11 a.m. And then we'll have 30 minutes of Q&A. I don't know if we'll have any time for Q&A inside the course of this session. And with that, we will start with our first speaker, Dr. Stacey Bosley. Stacey.
Thank you, Peter. I will go ahead and share my screen. Well, good morning, everyone. So I'll be talking again about earnings claims in multi-level marketing, but my focus will be especially on what we know about the impact of disclaimers and disclosures in that context. I just want to note that a lot of what I'm talking about today can also be found in the comment that I filed for the FTC's ANPR. And so please look there for more evidence or details regarding what I'm about to say today. So first, I want to talk for a moment about the context in which earnings claims occur in this industry and what we know about, again, the place that people are at when they are exposed to such claims. Most participants in multi-level marketing enter to make money. Again, please see my comment for a lot of the supporting evidence that goes along with these statements. Most do not make a profit. Most, if again, given the choice again, would not make that same decision. They face a significant risk of loss. There's information asymmetry in that the firm has information about past participant outcomes that the recruit or current participants do not typically have access to. And there's an incentive, as Bonnie Patton has described clearly, to represent atypical outcomes when recruiting or attempting to keep people engaged in the firm. Now, again, my comment addresses some of the evidence, but I just want to show you a couple of other pieces of evidence that align with the statements I've just made. The AARP Foundation study did ask people about their intentions, why they joined multi-level marketing, and found that 75%, or approximately 3 in 4 people, entered to make income. Again, that was just one data point on this. But the industry's own survey, there was a survey on the Direct Selling 411 site for some time, asking people what the primary was that they entered their engagement in this industry, what their primary reason was for that entry. Note that, again, multi-level marketing and direct selling in the United States are effectively the same in that based on the industry's own data, effectively all participants are participating within a multi-level marketing compensation structure. And so again, just note that those terms are, I'm using those synonymously. And this is true in many other countries as well. So when asked what the primary reason was you became a direct seller, I captured the votes on this at one point. This was late in 2013, but it gives another data point on what direct sellers themselves said was their primary motivation. And you can see of almost 32,000 votes, 85% of those votes said that the primary reason for entering the industry was to earn income. Only 8% said it was to buy products at a discount, 4% to be recognized for accomplishments, and 3% to meet other people. Again, the AARP Foundation study similarly showed that the majority earned to enter a profit, or that was their intention, but approximately 3 in 4 reported they had broken even or had a loss. Of those individuals, when asked if they would join the same MLM again, only 7% said that they would, and only 6% said that they would join a different MLM again. Even of those who reported that they earned a profit, which was again approximately 1 in 4 of the respondents who had been in an MLM, only 26% said that they would join the same MLM again, and 11% a different MLM. So in the context of, again, entering to earn income, most do not earn income. They're exposed to, again, the risk of loss. We see, again, the evidence of both explicit and implicit claims that, that consumers are exposed to, again, as discussed in the keynote address. And again, these claims can be explicit in the form of specific statements of earnings, in bonus checks, earnings received in commission checks, projected earnings, or again, of course, indications of lifestyle, time freedom, debt repayment, or other more implicit claims of earnings. Again, as Tina has shown, these types of claims are pervasive. And again, we also see these types of earnings claims appear in FTC cases and also in income disclosure statements themselves. And so I'll talk a little bit more about that. Again, I think it's fair to assume that all recruits are exposed to some forms of claims given the pervasiveness of these claims, and also, again, that current participants are also continually exposed to claims and are also, again, trained to repeat claims as part of their practice. So in the context of all of this, what do we know about how disclaimers function and disclosures as well? Are they a remedy for the kinds of earnings claims that we see? Last year at this conference, I reported to you about an experiment that we had done that had tested the impact of disclosure in MLM. I'm going to now, again, kind of compare that to the results we have of a second experiment that similarly tested the impact of disclosure in this context. So both experiments had the same basic framework. People who are randomly assigned to the control group received a business opportunity video of an existing MLM that's in the DSA, as well as the website material that firm had posted on their business opportunity pages. Now, inside that content, the video and the website content, there were embedded earnings claims. I just present two here for you as examples. For example, this company is looking for some real go-getters who want to make an extra $1,000, $2,000 a month. Do you know anyone who would like that kind of thing? Or freedom was within your reach, whether you want to earn some extra income or create a new life. Again, the opportunity is unlimited. So these are the kinds of claims, many others that were embedded in these materials. Also inside these materials was embedded disclaimer language throughout, both in the website content and in the business opportunity video. And so I'm going to come back to that in terms of what we find in the control group might give us some indication of what marketing content with disclaimers mean for consumer judgments. Again, then some were randomly and equally assigned, or effectively approximately equal numbers were assigned to control and the treatment groups with random assignment. And again, if you were in treatment group 1, you received these marketing materials, the video and the website content, along with the company's own income disclosure statement. If you were randomly assigned to treatment group 2, you received those same marketing materials, but a prototype disclosure that we made that simplified the information, put it in graphical form, and also included this leftmost, the largest bar that you see on the left-hand side, which was the percentage of people who earned $0 in earnings and income. And that number had been in the fine print text of the company's own disclosure. Again, comparing the results from the experiment 1 to experiment 2, experiment 1 used undergraduate subjects, while experiment 2 used paid subjects from the Mechanical Turk, Amazon Mechanical Turk platform. In experiment 1, we asked everyone about their interest in the MLM and then asked them about the earnings expectations that they had. In experiment 2, we randomly assigned people to one of two conditions. They either answered their interest question first and then earnings, or they alternatively answered the earnings questions first and then reported interest. We wanted to test this to see if consciously processing earnings had any impact on their interest in the business opportunity. We also, in the second experiment, had a larger sample size, so we were able to look for treatment heterogeneity. This is akin to looking to see if calorie labels, for example, or nutrition labels have different impacts on different consumers. That's effectively what we were looking for in this context. Does disclosure have different impacts for different types of consumers? And then based on feedback we had on Article 1, we also looked at whether or not there were any implications, again, or differences in how people reacted to disclosure if they perceived themselves to be better than average in this context. Now, again, the control group gave us an opportunity to see how people reacted when they received marketing materials that had earnings claims, but also had disclaimer language in them. And here I summarize for you the median responses for individuals in experiment 1 and experiment 2. And so we asked again, what's the typical amount you think you might earn, the minimum amount, the maximum amount, and your chance of earning $6,000 in a year. Now, again, these were right skewed distributions. So some people had much larger answers. So the averages exceeded the medians in this case. We weren't surprised to see that experiment 2, we had lower responses. These were older individuals relative to the undergraduate subjects who had more life experience. But we can see even the Mechanical Turk subject answers significantly exceeded what these individuals actually experienced in this company. So the disclosure showed that, again, nearly 3 in 4 participants had $0 in revenue. 90% averaged about $1,000 or less for the year in revenue. 97% $2,500 or less for the year. And again, the expected value, if we were to calculate it, would be about $1,500 in revenue for the year. And again, this is all before expenses. So the typical person's outcome is a loss, right? Even with factoring in the most modest expenses. And so we can see, again, a mismatch between the expectations that consumers have when confronted with marketing materials with disclaimers relative to the, again, the reality in this case. Now, when we looked at disclosures, we could see that there was, and I think maybe we need a mute there. Thank you. So then disclosures, I'm summarizing here for you, experiment 1, experiment 2. Please see again our papers and my comment for more details. But we can see that the disclosures did reduce expectations for consumers, but the prototype disclosure, especially that showed $0 earners, was much more effective in reducing consumer expectations closer to, not to, but closer to what are the objectively determined values for income in this business opportunity. And so again, more statistically significant reductions and more consistent reductions in expectations for the simple graphical disclosure that highlighted the percentage of people who earned $0. We also found on the interest front, while in the experiment 1, we found that that the undergraduate subjects who had answered the interest question first, there was no relationship between disclosure and interest in the income opportunity. On the other hand, when we randomly assigned people again to answer the earnings questions first versus interest, we found that those who answered the earnings questions first, right, which is asking them to consciously process what they may earn and potentially engage more with the disclosure, there on average, there was a reduction in interest after people had processed that disclosure and answered those questions. Now, interestingly, though, income disclosure does seem to appear, this is true in both experiment 1 and experiment 2, does appear to increase upper bound expectations, the most that people think that they could earn. For those in a particular subgroup, those with low numeracy or facility with numbers, and those with a better than average self-perception. And so there is some risk that even with the disclosure that we had that was graphical, that showed the $0 earners, that's not enough to highlight risk, especially for people who have low numeracy, again, or this better than average perception. And that's where we think it's incredibly important to actually disclose the salient information for a business opportunity, which is not income, but profit. And really, again, pivot from income disclosures to profit disclosures. For example, if you were to show a graph that had a color coding that highlighted for people the difference between losses and gains, and again, the sort of size of losses and gains using color, for example, to highlight losses, as we do in many nutritional labels or other things that use red, yellow, or green coding, color coding. A similar approach could be used here. We also may want to move from, while I have percentages here, we may want to use and test other ways of representing the share that are in each group. For example, maybe fractions as opposed to percentages. But again, you will see that this is a profit disclosure that must include business expenses, including payments made to the firm. And I know that my colleagues are going to be talking about the role of the purchases that individuals make, including the purchases of the firm's own products, and that's an important piece of the expenses that MLM participants incur. Additional profit disclosure elements could include, again, the types of expenses that they might expect to incur, litigation, attrition, and cancellation or refund policies. And importantly, the last thing that I just want to note is that, again, I make a case for a 7-day pre-sale waiting period, 7 days after receiving disclosure, where you can take that disclosure and process it in your own space and time. And in my comment, I referenced the literature that supports the importance of that kind of pre-sale waiting period. So you can't sign a distributor agreement or pay anything to the firm until you've had 7 days to process the disclosure. And similarly, maintaining a 3-day post-sale cooling off period, so that, again, once you've entered, you still have some time to think and potentially change your mind. Participants want to make money, they lack objective information. Earnings claims are atypical and pervasive. We see that people realize later that they wouldn't make the same decisions again, and disclaimer language is not enough. Disclosures can help under certain circumstances, simple, visual, communicating risk of loss, the chance of profit, and people having the time and space to process that information. And again, I just point you to my FTC comment for more details on the things I've said today. Thank you.
Thank you, Stacy, for that fine presentation. Our next speaker will be Dr. Deanna Grant-Smith from Queensland University of Technology in Australia. Deanna, you're on.
Good evening, everybody. Yes, I'm Associate Professor Deanna Grant-Smith, and I'm with the QUT Centre for Decent Work in Industry. And today I'd like to speak with you regarding some research that I have done with colleagues from Griffith University, and research that was funded by the Extra Foundation in Australia, formerly known as Financial Literacy Australia. The research that we were undertaking was particularly interested in understanding the financial literacy and self-assessed financial knowledge of the people who choose to become MLM consultants. Okay, why won't that go down? Before I start, I would like to acknowledge the traditional owners of the land from which I'm currently speaking, which are the Turrbal and the Yugara people. I would like to acknowledge that these lands were never ceded, and that they have always been lands of teaching, learning, and of research. And in particular, I'd like to pay my respects to their elders, laws, customs, and creation spirits. This is particularly important to me because anecdotally, we've been told that within the vulnerable groups of people who are being targeted to become multi-level marketing consultants, that our Indigenous people are among those groups who are being drawn into the perceived opportunities associated with multi-level marketing. So what we tried to do with our study was to actually understand the types of Australians who were choosing to become multi-level marketing consultants. So our research was based on survey research, and we were interested in both the demographic characteristics of the people who were responding, but also a number of their psychographic characteristics as well. And most importantly, we were looking at the level of financial literacy and knowledge that multi-level marketing consultants had, and their previous selling and business experience. To do this, we used a Qualtrics platform, and we had a sample of 287 multi-level marketing consultants. Within that sample, 209 were currently multi-level marketing consultants and 78 were former consultants, but the majority of those had been a consultant within the last 2 years. We also took the opportunity to engage a non-multi-level marketing sample as well, so that we could do some comparison between how multi-level marketing consultants, so the people who are attracted to these kinds of opportunities or perceived opportunities, might be similar or different to a general population of respondents. So we compared this multi-level marketing sample to a sample of 235 non-MLM participants. So these were people who had never, ever been an MLM member. In terms of the composition of the samples, for the non-MLM sample, we used a sampling strategy that was consistent with the Australian population and used a gender quota of 51% female respondents. Within the MLM sample, we did not set any gender quota, and it was just as soon as we had the requisite number of participants, and approximately 60% of our sample identified as female. In terms of the questions that we asked, many of these were actually based on the AARP study that was done on MLM, but also a number of robust financial literacy measures that already exist. Similar to the two presentations that we've already heard this morning, we found that within our multi-level marketing sample that the primary motivation for joining multi-level marketing was actually to earn extra money. That was the vast majority of participants. And we can also see here that the opportunity to buy the products at a reduced cost was far less commonly reported as a reason for joining. And we actually allowed respondents to choose more than one of these motivations for joining. So we can see that even when they had the opportunity to identify multiple reasons for joining, purchasing the product still wasn't a particularly strong motivator for becoming involved. Because we were interested in financial literacy and perceived financial knowledge, we were also interested in the kinds of experience that multi-level marketing consultants had prior to joining. The reason we wanted to know this is because in Australia, as elsewhere, multi-level marketing is often presented as a business opportunity where individuals are perceived to now be owning their own small business. What we found, however, was that 40% of respondents had no experience in sales where their income was primarily based on commissions before they joined. And if we add to that the people who had less than 1 year of this kind of experience, it means that more than half had no sales experience, but were going into a role where this was basically what they would be required to do. We also found that 52% had no experience in running their own business before they joined. And if we add to that those who said they had less than a year, we're looking at 3/5 of them having absolutely no business experience as well. So in addition to looking at the sample as a whole, we utilised what's called a profile analysis approach to investigate the possibility that the sample might have multiple subpopulations within it. And we used something that's called latent profile analysis. So what latent profile analysis does is it creates different profiles based on different configurations of, let's say, set elements. And the two things that we chose were financial literacy and perceived financial knowledge. And through this latent profile analysis, we identified that there were 4 distinct profiles of typical MLM consultants within our sample. And so we can look at them as individuals, but we can also compare them against the sample of respondents who have never been an MLM consultant. Within our sample, we've named them. So the first was self-aware inquirers. Then we have aspirational devotees, prudent evaluators, and trusting self-doubters. And as I move through my presentation, you'll be able to see how the names we've given them reflect their characteristics. So with our aspirational devotees, we found that these were a group of consultants that typically overestimated their personal financial knowledge relative to their measured financial literacy. Unfortunately, these were also the consultants that were most likely to make the most significant time and financial commitments to their MLM business. And they also had very high levels of materialism and status orientation, which meant that they're very likely to be attracted by the appeals that many of these companies make in relation to things like material gain and recognition, for instance. This can be compared to our group that are called the self-aware inquirers. This group also has low levels of financial literacy, but they actually have a more accurate understanding of their low level of financial literacy. And as a result, we find that these consultants are actually more willing to seek financial information and financial advice in relation to their opportunities. Unfortunately, despite this information seeking behavior, their understanding does not reflect that effort. So they remain with poor knowledge and literacy. This can be compared to our two other groups, both of whom have what could be considered higher levels of financial literacy, but they differ in terms of the extent to which they believe that they have this level of financial knowledge or literacy. So first we have the prudent evaluators. So these are individuals that possess excellent financial literacy and confidence, and they also have above average informed decision-making behaviors. They're also more likely to be seeking out information as well. So these are definitely the kinds of people who you can target with information. They will understand it and they will use it to shape their decisions. We also have the trusting self-doubter group, which they're financially literate, but they wrongly perceive that their financial knowledge is poor. So they lack confidence in their own decision-making ability. These people are also less likely to have sought information from a range of sources or to have compared alternatives before they join. And generally, this is because they don't trust their own judgment in relation to the decisions that they're making. So if we were to look at the idea of financial literacy more broadly, basically what I'm referring to there is somebody's knowledge and behavior, particularly around personal finance. So it's looking at things like numeracy and financial concepts like inflation, compound interest, risk, and returns. Having good financial literacy is obviously very important for someone to manage their personal finances, but it is inherently important for business success, including in multi-level marketing. The most common measure of financial literacy is called the Lasardi and Mitchell Big Three questions. And we used a version of that has been adapted to the Australian context. When we look at the performance of these four groups and the general population of non-MLM consultants, we can see here that those first two groups, the self-aware inquirers and the aspirational devotees, perform poorly, both relative to other MLM consultants, but also to the general population and the expected results that we would see. The Lasardi three big questions is actually a very robust measure because our general population got roughly the kinds of number of questions right that we would expect relative to the estimates that had been found in other studies. And we typically found, again, that these prudent evaluators and trusting self-doubters were performing well. They weren't just performing better than the other MLM consultants, but many of them were also performing better than the general population overall. When we look at this, we can see that the level of understanding on these questions is meant to, I guess, decrease as we go through them. The easiest one is first and the most difficult one is third. So we would expect the number of correct answers to decrease as we move through, but we would be alarmed to be seeing only 9% of a group getting questions right, for instance. If we were to look at the total number answered correctly, you would generally expect somewhere between about 43 or 45% of people to be getting all three of the questions correct. The aspirational devotees and the self-aware inquirers, none of them got more than one correct of the three, which is extremely troubling, particularly given that these are the people that tend to have the greatest investment. We can also look at the idea of financial literacy more generally within the MLM context. So in addition to the big three, we developed specific questions relating to MLM. The questions that we developed looked at the kinds of things that need to be considered for someone to understand if their business is profitable and to run it successfully. So we looked at things like whether or not these people could calculate a profit based on hours worked, based on commissions, based on costing personal labor, based on borrowing, and based on a proper calculation of indirect costs. And again, we can see that those first two groups performed very poorly against all 5 of those questions relative to the general population. And we can even see here that even within our more financially literate MLM consultants, they typically weren't outperforming the general population as a general rule. So we can see here that even within the context where they should have the best financial knowledge, they didn't necessarily. When we look at this against the number of questions answered correctly, almost half of these aspirational devotees answered none of the MLM specific financial questions correctly, which is incredibly concerning. We can actually understand them relative to each other when we look at this graph that shows how much worse than each other they are. And we can see that with these aspirational devotees, it's that disconnect between what they think they know and what they actually know. So the orange versus the green, that brings us our concern. The percentages I have along the top is actually the percentage composition of our group that they were, and these aspirational devotees were about 20% of our group. The self-aware inquirer is 27, so that means that, you know, a little more than half of our sample had okay financial literacy or good financial literacy. The other end did not. In terms of perceptions of MLM, concerningly, it was those people with those lower levels of financial literacy that were more likely to agree that the income disclosure statements were both accurate and that they accurately represented the likelihood of financial success. I think one of the things that really concerns me when I look at this is these people who are the aspirational devotees. They were also more likely to say that being a consultant had a negative impact on other parts of their life, but were also the most likely to say that they would join this company again or another company. So there's a lot of cognitive dissonance going on within this group relative to the amount of investment and knowledge they actually have. As I said before, they also tended to outperform the other groups in terms of being impulsive, materialistic, having a locus of control around themselves, and being very motivated by a status orientation. So we came up with 3 recommendations from our study. The first was to develop resources for people considering joining an MLM. And that's because about half of our sample were really likely to be receptive to this kind of information, and it could support them to make an informed financial decision before joining. Our second recommendation was to do more research about this aspirational devotee profile, because they're actually unlikely to access that information because they think they know it all, and are also less likely to understand it even if we provide it. And then finally, we found that even with information seeking behaviors among some groups, we don't have a high level of confidence given the complexity of multi-level marketing and the diversity within that market, that financial professionals like accountants or financial planners in Australia necessarily have the knowledge that they require to provide tailored advice regarding multi-level marketing businesses. To conclude my presentation, I'd just like to share with you one of the videos that we prepared through our study, and it is on a website on YouTube called MLM Informed Choices. And these are short videos that we prepared to help people make an informed decision before they joined an MLM.
Deanna, is there a sound that we should be hearing?
There is, but it's quite annoying anyway. Okay, so if you'd like to read more about our study, it's available through the QUT website at that address. And you can also see the videos on our MLM Informed Choices YouTube channel, where you'll get to hear the soundtrack that accompanies that video, which is, you can probably see me dancing in the background. It does become quite tedious over time. So thank you very much for your attention and for this wonderful opportunity to present.
Thank you. Thank you, Deanna, for that very informative presentation. Our next speaker will be Dr. Claudia Gross from Radboud University in the Netherlands. Claudia?
Yeah. Here we go. Thank you, Peter, and thank you to everyone making this conference possible. So I will talk about buy more, earn more. Is this possible? Because did you ever want to become rich in multi-level marketing? Or do you know someone who tried that? Probably yes. Multi-level marketing companies attract millions of people around the globe, and they allege fantastic income opportunities, make people to join. So these companies earn a lot of money, but distributors do not. And one reason is that they spend far more than they ever get back. But why do that many distributors invest more in products that then ever get back? I have one question, Peter. Do you see the whole screen with the black thing?
I do see the whole screen as far as I can see here. Yes.
There is no, sorry. Okay, so you don't see the next slide already, things like that.
We have
We're-
presenter view.
Yeah.
Precisely. I want to change that. Sorry. I don't like that. It came up. Sorry, I'm at the university. Okay, let me check how to change that.
Looks good now.
It looks okay now.
Sorry. Sorry for that. I will try once more, otherwise we do it as it is. Sorry. Okay, this is what I wanted to have. Okay. Okay, it's like it is. Okay, sorry. So why do that many distributors invest more in products that then ever earn back? Yeah. So answers by companies, upline members, industry advocates would go like this. It's the own decision of people. Everyone is free to buy how much or how little he or she wants. There are safeguards that protect people from spending too much money on products, stockpiling them, and to ensure retail sales. And whoever does not make a profit has not worked hard enough. Research shows a completely different picture. So as Bonnie explained, deceptive earning claims are very widespread. And as we learned from Stacy, incomplete, or far too difficult to understand or not very effective income disclosures do not help. And as Diana showed us, many distributors lack the financial literacy to know about the risks. My contribution today is a model on why distributors are pressured to buy and why safeguards and policies that exist are insufficient. Our research is based on ongoing research at this university That's the Radboud University in Nijmegen, the Netherlands. And my research is together with Dr. Matthijs Moorkamp and Dr. Dirk Frins. What we do in our research is to provide a model. We use insights from business ethics and analyze what we know about how MLMs work. So what can we learn from business ethics? Friedson and distinguishes between institutional ethics. So this is the context in which people act. And practice ethics is what people do and how and whether they behave themselves ethically. In the case of MLMs, this means the following. It allows us to ask questions. First, how do companies pressure their distributors to buy? That's the context. Second, how do distributors who are under this pressure turn from victims to perpetrators? What makes them behave unethical themselves? Third, why do safeguards existing policies not prevent harm? And fourth, what do we need? Now, in the context of MLMs, distributors are subject to many conditions that are set and defined by the company. So distributors can't sneak out. They are self-employed, but they are subject to these conditions. The context consists of two main categories: financial economic ones, mainly pay to play, and social conditions, buying the train. MLMs around the world can differ and do differ on these conditions, but in their core, they have all these features. Okay. There are many financial economic conditions, so let me give a few ones. There are actually more. The first condition is the retail promise. But how does retailing stimulate people to overspend on products? Very simple. Before you can retail, you need to buy. You need to get familiar with products, and therefore you need to buy them. To be able to demonstrate products, you need to buy them first. And in case you want to sell them directly on location at a party, you need to buy them first. And to potentially retail more, it makes sense to buy more different products so that you can demonstrate more different ones. And to earn more, it makes sense to buy a lot because then you get more discounts. And there are more aspects like this. Be aware, some companies have hundreds of products. So buying them to get to know them can cost already a lot of money. But the core problem is this passive income promise. How does it stimulate distributors to buy products? This is the pay-to-play aspect. To earn on others, you need to recruit. Okay, and your group, including you, needs to create a group turnover on products, because the more you and your group buys, the more commission you as an upline member will earn. And to achieve that certain level, you might need to buy products yourself at the end of the month just to hit the next mark. And of course, it makes sense to tell your downline to do the same so that you get more commission. So products are bought not because anyone needs them or wishes to consume them, but in the hope to earn money. And these commissions are mostly paid for buying products, and they're not related to retailing them. There are some rules that should ensure that retail exists, and I will come back to them later. For now, the core idea is, by all these financial incentives, MLM companies create a turnover and make profits. So distributors create group and company turnover, but many do not make profit. The social conditions come on top on this. So the hope to earn makes people to buy into the dream. Yeah. So first, the ideology. MLMs are famous for their very strong values. So, and most companies present themselves as helping or even saving the world. They elevate pretty mundane activities such as buying, selling, recruiting others to community and even life-saving activities. So buying products, buying them in bulk, buying them each month, is presented as a really good thing because it shows that you believe in the values of the company and that you dare to think great. Second, the recognition and status system. Social recognition is a strong motivation to buy. We see that in the literature because MLMs do not only give financial incentives, but who buys more and whose group buys more receives more social recognition. Top performers are allowed to speak on stage, small performers in the local meeting, and really good performers on national rallies. And the bigger the group and the turnover, the fancier the title. So gold is more than silver, a double diamond is more worth socially than a single diamond, and an eagle is socially worth more than a normal, simple distributor. So social recognition is a motivation to buy. Okay. The third point is education. MLMs have a very particular way to educate their people because this is done by upline members who are not paid for these efforts. So all the management tasks, the recruiting, the motivation, no one is paid for this by hour or with a wage, only by group commissions. And these group commissions are related to product turnover, to the buying of the group. Thus, to earn money for all these hours of work, of motivation, of recruiting, it is really financially and socially attractive to motivate downline distributors to buy more. And this is what companies or what upline members do. They tell their downline how good it is, how important to buy, to believe in the dream. Yeah. And in the case a company has rules to pay commissions based on end customer sales, it might also seem attractive to find ways to work around these rules. I'll come back to them later. Now, okay, so education. Now I come to the model. Here we see first the institutional context and the practice context. So the institutional context is what the organization does, how it is set up. And the idea is that all these financial conditions and the social conditions, they all reinforce each other, and all together they make distributors to buy products, pretty independent of whether they want to consume them, need them, can retail them. A single condition, like for example a discount, might not put a pressure to buy, but if you want to get rich and you cannot retail and you need to earn money back, then buying a lot to earn later more and to be recognized for what you do, that altogether puts a strong incentive on buying. The second arrow connects what the organization does to what distributors do. So distributors are under this pressure. This is arrow 2 now, how they behave towards others. From a business ethics perspective, it is no surprise that distributors who are under all this pressure pass on this pressure to others. Yeah, so that distributors who have bought too many products start to use aggressive marketing techniques to get rid of at least some of them. Yeah? And that distributors make problematic health claims, for example, to be able to retail a few products, so to get back some money. Or that distributors who are under this pressure try to recruit others. Because if you have invested a lot in products, how will you earn money? You can turn to recruiting. This is offered as a solution. Yeah. So from a business ethics perspective, it's obvious that people who are under pressure by all these conditions are more prone to turn to ethically problematic behavior towards others. Yeah, look, it's not impossible, but it's very, very hard to be ethical oneself in a system that is basically unethical. The last part of the model is this, the third arrow. And this is the most important one. So MLMs have a very particular way of making distributors part of their own system. Because as soon as you recruit, you will start educating others. And what do you teach to your downline? You probably teach the same that you were taught, that it's good to buy products, it's good to dream big, it's good to dare to buy, it's good to recruit others. So this arrow 3 ensures that there is a feedback loop between the pressure that is put on distributors and that distributors who recruit also put the pressure again on new distributors. And this way, the problems of deceptive income claims, of these illegal health claims, and the dubious marketing techniques, they persist because here it's very hard to sneak out. It is difficult to behave ethical in a system that has so little possibilities to earn money in any other way. Okay. Before I turn to the solutions, I summarize with the 3 first questions. So first, how do companies pressure their distributors to buy? They have many financial and social conditions in place that stimulate distributors to buy internal products. The more conditions are in place, the higher the pressure is to buy. And these pressuring others is definitely unethical. Second, how do distributors turn from victims to perpetrators? When distributors are under this pressure, they are prone to pass on this pressure and to pass on all kinds of problematic health, income claims, misuse, social relations. Yeah, and by recruiting others, distributors are assimilated into an unethical system and they risk contributing to it themselves. Why do safeguards, existing policies, not prevent harm? Our model can help to understand that. So one way how the industry claims to prevent harm is to say we have refund and buyback rules. These are important rules for all kinds of products and services people can purchase. It is good to have them, but in the context of MLM, they are not sufficient. They have been criticized already for practical reasons. For example, that it's hard to return products, packages should not be opened, products need to be in season, and so forth. And it might also be difficult to give back products because then this affects your earlier upline members and they need to get back commissions, and that might be socially hard. But our point is a different one. Buyback policies do not solve the pressure to buy because the pressure goes first to distributors. And this error 1 is not solved by buyback policies. Yeah, they can never prevent harm. They can mitigate harm when they work. But to prevent harm, this error 1 should be fixed. And here these policies have no effect on this error 1. Retail rules. So here I refer to rules like the 70% rule or the 10 customer rule. They should ensure that there is sales to end customers, to people outside the system, and that real retail takes place. The problem is that distributors who are under this pressure, the rule asks them to retail more. So this actually can sandwich distributors. So they have the pressure to buy and the pressure to retail. And the risk is, and we can observe that when distributors have real difficulties to retail products, that they solve the pressure by circumventing the rule or by faking retail sales. For example, by giving the credit card numbers of siblings or the children, or asking neighbors or friends to buy products and to buy them back from them. Yeah. So while this rule was meant to ensure retail, it actually can put a double pressure on these distributors here to retail and to buy. And if upline members see that they need retail to end customers to get their commissions, they might also try to circumvent and invent ways how to fake retail. Okay. The preferred customer category is another rather new rule, but it also seems to backfire too. For the sake of time, I will not elaborate on this now, but go to the last question. What do we need? Better legislation and more enforcement. I'm in line with Bonnie's statement and ideas. And I would say, stop recruiting. Go back to single level marketing, the actual direct selling. From our research, it is so clear that the multi-level marketing system is the core problem or the core cause for many, many problems. For the EU, I think the directive on pyramid schemes needs to be revised. It now explicitly protects consumers, but as soon as people sign up at an MLM, they become distributors, while they are not business people. Yeah, they are formally self-employed distributors, but actually they are dependent self-employed. So better new labor laws regulating this category of dependent self-employment would also be a good solution. For the US, more enforcement and better rules against deceptive earning claims are a good step in the right direction. And also, as Stacy explained, profit instead of income disclosures can help. There are more things to say, and I'm sure that Douglas Brooks, the next presenter, will tell us more. I want to end with consumer education, yeah, because consumer education is very valuable, and I'm very happy that I can participate in this conference, and I want to thank everyone.
Thank you, Claudia. Thank you for a very penetrating analysis. Our last speaker this morning is Mr. Doug Brooks, who will start his presentation now. Doug.
Thanks, Peter. Let me see if I can figure out how to how to use this PowerPoint. All right, does that seem to be working?
Yes.
Yes.
Good, thank you. And I'm really honored to follow all these academics. I'm going to get down to maybe a more mundane issue, which is how do we what are the existing remedies and how adequate are they to deal with this problem and the prevalence of deceptive earnings claims. And the theme for my presentation is some lines from the Coscott decision from 1975, where the Commissioner Dixon, for speaking for the Commission, said, "It is regrettably clear that responsible authorities, including this Commission, have acted far too slowly to protect consumers from the manipulations of respondents and others like them. Whether more than a small fraction of the consumer loss will ever be recovered is open to serious doubt." And here it is almost 50 years later, and I have to say that those lines have as much relevance today as they did then. Existing remedies, to go to the end of my topic, existing remedies are inadequate. I'm going to start off talking about the Federal Trade Commission. There is no federal statute or regulation that specifically covers MLM or pyramid schemes. The FTC can bring enforcement actions under its general authority to prosecute or prohibit unfair or deceptive acts or practices in trade or commerce. And it has followed a case-by-case enforcement policy with respect to MLM. And you know, you might ask, well, how's that working out for you? It's not working out too well. It doesn't prevent the vast majority of MLM companies from engaging in the practices that Bonnie and the other speakers have talked about. And adding to the problems with that remedy is a Supreme Court decision that came down last year, a rare unanimous decision by the Supreme Court, which held that the statute that the FTC had been using when it did bring cases against MLM companies does not permit the FTC to get restitution for victims. They can get injunctive relief, ordering a company to stop being a pyramid scheme or to refrain from making deceptive earnings claims, but they can't use that procedure to get money for victims. So for instance, the Herbalife case that came down a few years ago, which both had required Herbalife to change its practices and assess $200 million in restitution, this Supreme Court decision means that that kind of case can't happen. Right now, the only way the FTC can obtain restitution for consumers is by pursuing a cumbersome administrative remedy, which is what it did back in the 70s. The Costco case, Amway, Holiday Magic, were all cases that followed this administrative procedure, and they all took 3 or 4 years, during which time the companies continued to operate and continued to increase the losses. The Supreme Court, I think, in AMG Capital was suggesting that the FTC should do both things at once. In other words, bring an injunctive action to stop the bleeding, and then pursue this administrative procedure to prove that the companies were engaging in unfair practices and ultimately get restitution. That, to my mind, is a very cumbersome and wasteful procedure, but that's what the Supreme Court seems to be saying to the FTC. The FTC has taken a few steps in response to that decision, one of which, Bonnie mentioned this, is the Penalty Offense Authority. The FTC has sent notices to hundreds of MLM companies warning them about deceptive earnings claims. And there is a different statute which enables the FTC to go into court if a company is violating a practice that has been found to be unfair or deceptive, and assess civil penalties. But that still is not restitution. This is an underutilized procedure. I have a concern that federal judges will be uncomfortable with assessing draconian penalties that don't seem to relate to actual consumer losses. But it is something that the FTC can do while they try to figure out something better. Alternatively, you could have a rule, and once you have a rule that defines an unfair or deceptive practice, the FTC can immediately go into court and enforce that rule, so you don't have the problem indicated by the AMG case. And the FTC has done this, and they have indicated that they are ready to do more rulemaking. Back in 1979, after an 8-year process of hearings, they promulgated the franchise rule. At that time, it was called the Franchise and Business Opportunity Rule because it was intended to not only cover franchises, but all other types of business opportunities. The rule requires disclosures to be made at least 14 days before the franchisee signs anything or buys anything. And if the franchisor makes earnings claims, they don't have to make earnings claims, but if they do, they have to have a reasonable basis and they have to provide written substantiation. This would be a great rule for covering MLMs, but there is an exemption. If there are no required payments in excess of $500 within the first 6 months of operation, you're not covered by the rule. So most MLM companies simply make sure that their starter kits or whatever they require is less than $500 within the first 6 months. There's also provision in the franchise rule that reasonable quantities of wholesale goods don't count towards that limitation. And you could argue that the required inventory purchases by that MLM distributors are required to make in order to earn commissions and qualify, that these should not be considered bona fide wholesale purchases. I've tried to make that argument in a few cases, and I have not been successful. So back in 2012, the FTC passes a new rule, the Business Opportunity Rule. That rulemaking process began in 1995, so it's a really a glacial pace of rulemaking. This is similar to the franchise rule in that business opportunity sellers have to provide disclosures 7 days before the purchaser signs a contract or pays any money. Again, earnings claims must have a reasonable basis and they must provide written substantiation. And again, that would have been great for covering MLM, but the industry got itself exempted from the BizOp rule. So the rule has really quite limited coverage. So moving on and still staying within the federal system, we also have federal securities laws, and it may seem odd, but an investment in a pyramid scheme is considered to be a security, which means it's subject to the registration and disclosure requirements of the federal securities laws. This is important for private plaintiffs because while there is no private right of action under the FTC Act, there is a private right of action for violation of securities laws. So frequently private lawsuits against MLM companies will rely on securities claims. And the versus money trading case, where I was one of the counsel for the plaintiffs, held that the FTC's definition of pyramid scheme in Costco also applies to securities cases. But this is not an ideal solution to the problem. Securities cases are very difficult to pursue. There are a lot of requirements that have to be met, things like loss causation and other complexities that I don't have the time to get into. But you know, it's what we're faced with. It's what we're stuck with for the moment. Wrapping up on the federal side, we also have the RICO statute. RICO was intended to deal with organized crime, but it was written broadly enough to cover organizations that conduct their activities through a pattern of racketeering activity, which includes mail fraud or wire fraud. And the Department of Justice has prosecuted some MLM promoters and companies using the mail fraud and wire fraud statutes. They haven't, to my knowledge, used RICO against an MLM company, but there's no reason that they couldn't. And again, RICO does have a private right of action, so private plaintiffs have utilized RICO in lawsuits against MLM companies, but there's a catch-22. Without getting into all the details, if you allege that an MLM is a pyramid scheme, even if you don't invoke the securities laws, the Securities Reform Act provides that you can't use the securities violation as the basis for a RICO case, and therefore you can end up pleading yourself out of court and losing your RICO case merely because you've alleged that the company is a pyramid scheme. So another sort of imperfect, inadequate remedy. State laws, there are a few states that have laws that expressly regulate MLM. The remedies are limited and enforcement has been spotty at best. Similarly, with state anti-pyramid laws, many states have them, but enforcement actions are rare. And the industry, the Direct Selling Association, has been very effective at going on a state-by-state basis and getting the anti-pyramid laws changed to fit their model, which essentially legalizes internal consumption, provides an internal consumption, is retailing, which means you could have a whole system of distributors that are the only buyers in a multi-level marketing company. And they essentially legalize pyramid schemes, which, as long as they have a product buyback provision. That seems to be the preferred remedy for anything that any problem under these statutes. Again, an inadequate remedy. There are state franchise laws, but they have the same problems that the FTC franchise rule has, which is most of them have a $500 threshold. And similarly with state business opportunity laws. Again, most of them have a threshold of $500. Some have a lower threshold, but again, these are not really adequate for the job at hand. There are more general state consumer protection laws. Some of them are modeled after the FTC Act, and they prohibit unfair or deceptive practices. But there are, each statute is different, and many of them have problematic issues which make them less than viable for MLM distributors who are trying to recover their losses. And also those differences may make it difficult to certify nationwide classes, which may be, and I'll get into this in a bit, may be the only viable way for individuals to recover the losses if the government doesn't work. So to get into, now I'm going to shift into talking about individual lawsuits, private actions against MLM companies. And the first thing you have to look at are the MLM distributor agreements. And these agreements, which typically are signed without the benefit of legal counsel, and in most cases without the individual reading or understanding what they're signing, they have very sophisticated commercial provisions that you find in franchise agreements, for instance, and other types of commercial agreements that sophisticated businessmen who are represented by lawyers enter into. Things like waivers of jury trials, waivers of class actions, arbitration clauses, which put you out of court completely, choice of venue clauses, where if you want to bring a lawsuit, you have to go to the MLM company's home jurisdiction. Limitations on the kinds of damages that you can recover. Maybe I've seen many clauses that limit your recovery to the return of product, and not your lost profits, not your consequential damage, not all the expenses that you incur in running your distributorship. Integration clauses. These are clauses which say you are, by signing this agreement, you are agreeing that you have not relied on any promise that was made to you that isn't set forth in this agreement. So someone who is recruited with a promise of earning income with one of these deceptive earnings claims that you've heard the other speakers talk about, the contract says you're not relying on that. And that is, in many courts will treat that as a strong defense to any effort to sue an MLM company. There are also restrictions on when claims may be brought. Typically, any type of claim has a statute of limitations, but by contract, you can lower that, reduce that statute, those are very common. There are also issues in MLM agreements that actually create claims by the company against the distributor. There are non-disparagement clauses which prohibit criticizing a company. MLM companies have not been shy about bringing actions under those clauses. Non-competition clauses, clauses which prevent you from recruiting in another MLM while you're in one, or even for a year afterwards. Clauses regarding trade secrets. You may be surprised to learn that after you recruit a downline, that downline is very often is defined as a trade secret owned by the company. You can no longer treat the people that you've recruited as sort of your market. It becomes the property of the company. And there's also the issue of unclean hands. And you heard Dr. Gross talk about the incentives for distributors to lie about retailing. Those types of practices can make it problematical for people who are trying to recover their damages, because the company will say, well, you told us that you retailed this product, but in fact, now you're telling us that you didn't really retail this product. And of course, this issue of the victim becoming the perpetrator. If you're complaining about a deceptive earnings claims, but you repeated that claim yourself when you recruited your downline, so that creates a problem. So I mentioned class actions. The other big problem with individual cases is that most people can't afford to pay legal fees, and if you want to have a contingent fee lawyer represent you, you need to have a lot of damages. And even if you've lost $5 or $10 or $20,000, which is a lot of money to you, that's not enough money to justify a contingency fee case. So class action becomes one of the most, or one of the only viable ways that folks can bring private actions. But class actions are very difficult. There are very rigorous set of requirements that have to be met before your case can be certified as a class action. And many cases fall down on the class issue. You have to prove that common issues predominate over individual issues. Well, MLM defendants are very good at trying to find all sorts of individual issues, whether in damages, what representations were made to which class members, issues of reliance, what person did or did not rely. And just to give you one example, just a few months ago, a case against the MLM Life Vantage in Utah, the court denied certification due to individual issues of damage. And it pointed out of their two class representatives, one of them decided to consume the products that he had, and the other one just let them pile up in his garage. And the court felt those kinds of differences would make it unfeasible to pursue a class action. Even though in a 50-page decision, the court denied every other argument that the defendant raised against class certification, which points out that the defendants in these cases, they only have to win on one issue. The plaintiff has to meet all of the elements for class certification, which means that the defendant only has to prevail on one. And it is very difficult to get these cases certified. I've done it, but it is a tough situation. The
Doug,
biggest problem with,
if you could finish up shortly, please.
thank you, Peter, I will speed up. The biggest problem with class actions is that they are never going to solve the problem of multi-level marketing. They may recover money for a group of distributors, which is certainly a good thing, but there's no incentive by the class action representative or by their lawyers to force the company to make real changes. It becomes simply an issue of how much money is the company willing to pay and how much will the plaintiffs are willing to take. Is there reason for hope? Bonnie mentioned the latest rulemaking by the FTC. There was a public comment period which expired on May 10th. The FTC received 1,672 comments. Not all of them have been posted yet. I have read about a third of these comments, and the vast majority, by my count, 95%, are by people who are in MLMs or are concerned with MLMs, and they favor regulation. There were very few comments regarding other industries. There were a few comments by the MLM industry itself, but as I say, the vast majority were people. Some of these were very short, but some of them were very long. Some of them, people really, I found it very moving to read through people's experiences and why they wanted the FTC to do something. The comments that I read mentioned 88 different MLM companies. The top 10 were Monat, Beachbody, Mary Kay, Amway, Arbonne, Paparazzi, It Works, Young Living, Color Street, and Pure Romance. And I make that point just to demonstrate that this is a widespread problem. This isn't not a problem of a few bad actors. This is a problem that is endemic in the industry. And I would urge the FTC to take a serious, I know they are taking a serious look at it, but I think MLM deserves special treatment due to the extent of the injury that it causes and the number of people that are affected by this. And thanks very much, Peter, and I will yield the floor.
And thank you, Doug, for your presentation showing that the current legal structure regarding MLMs has very limited avenues for providing effective consumer protection. Bill, at what
and the structures and the tax system is not great for it either. So yeah, we're very keen to investigate how much financial professionals actually understand MLM and could provide meaningful advice.
Thank you, Deanna. I think everyone has just seen me live, realizing that I wasn't recording the Q&A session. So I've just started doing that now, and I apologize to Stacey and Claudia, who've given their answers to their earlier questions. Yeah, I thought that was really interesting. Again, I had a student who was a CPA and ended up sort of coming, like getting distributor kits and almost signing up to try and understand the sort of payment structure and to understand the tax implications. So I think that's a really, really interesting topic. Doug, I think this one is for you. What kind of lobbying effort was involved in the business opportunity rule being altered?
Well, the timing was, I think it was 2006 when the FTC came out with the original version of the rule that would have covered MLM. And then in the public comment period that followed, the industry they had a multi-pronged approach. One prong was they galvanized, I think about 15,000 distributors to send letters, form letters, just signed copy, cookie cutter type letters and basically flooded the FTC with these letters opposing any regulation of MLM. The industry also, maybe more importantly, got a group of, I believe, ultimately 80 Congress people to send letters. Again, I think there were a total of 4 letters, each signed by multiple Congress people, and all the letters basically saying, don't destroy this this industry. You know, don't overregulate. The typical regulation arguments, and that resulted. I obviously I do not know what went on internally at the FTC, but about 2 years later, the FTC issued a revised version of the rule that exempted MLM offerings, and that ultimately that is how the rule came out. That's as much as I know about the lobbying.
This is again probably for Doug. Can someone on this panel clarify the differences between the roles and power of the FTC and the SEC in this area?
It's an interesting overlap. 2 agencies with very different mandates, very different statutory bases, but somehow they both cover MLMs. FTC through its general authority to protect people from unfair, deceptive acts or practices. Securities Exchange Commission from its mandate to cover securities, which are securities in essence is an investment of money in a common enterprise with profits primarily from or solely actually from the efforts of other people. And then case law has said, well, solely doesn't really mean solely, it means significant. Those 2 different threads sort of came together in the Webster and Omnitrition case, where the Ninth Circuit said, we're going to use the FTC standard for what a pyramid scheme is and apply it to a securities case. So that these 2 very different statutory matters sort of dovetailed, and it's just an interesting historical accident. I don't think anyone planned that. My understanding is that the 2 agencies do have a procedure where they basically they try to avoid stepping on each other's toes. So if the SEC is investigating an MLM, they will check with the FTC to make sure that the FTC isn't investigating the same company. Going back to the 70s with Costco, you saw both an FTC prosecution and an SEC prosecution of the company.
There's a question here where someone is talking about how do I begin to share and write my story, and I just want to address it because obviously it's a topic that comes up a lot. The session 8 tomorrow is all about how do victims recover, and session 7 is about how you can be an effective as a content creator, how you can be an effective activist. So I think those are really relevant questions for that session, perhaps more so than for our sort of more academic panel today. Just because Bill mentioned that he was particularly interested in this area of internal consumption, and it's sort of in the topic title. Claudia, I might just ask you to lead a little discussion on that for a moment about how widespread this actually is.
Yeah, internal consumption seems to be very widespread. And it's a pity that we do not have real figures for the whole industry. But if there are accusations of pyramid claims and there's a settlement, that we can see actually how many products are bought internally. And yeah, I talked all the time about internal buying because internal consumption, using the term consumption, is already a kind of fig leaf for me, a euphemism that does not cover what's going on, because consumption sounds as if it's about consumption. But it is more from a headquarters perspective that companies are able to sell products and earn money to the distributors, and whether they can consume them, want to consume them, need them, or whatever, that's not the point. So the core system is actually that distributors buy a pretty big share of these products. And yeah, that's why they make many MLMs pretty much like pyramid schemes, even though they're still legal.
And I would like to add a little bit up on this myself from my own experience. Internal consumption, as we all realize, refers to the fact that the distributors buy the product and consume it. Now, there's nothing wrong with that fact. And sometimes the industry says the government does not recognize the legitimacy of internal consumption. And I want to say that's not true. It's perfectly fine that distributors buy the product at a discount and consume a fair portion themselves. In fact, in the first case on this issue, going way back to Amway, distributors could consume up to 30% of the product without any challenge at all. And so the issue is not, may distributors consume a fair portion of the product? The issue is, do they get rewarded under the company's compensation plan for their personal consumption? That's the key issue. And the more you reward or tie rewards to your personal volume as part of your group volume, the more you will see that indeed the distributors have a pressure to buy more product, whether they sell it or not. They therefore will consume it by default. Right? So the issue is what was discussed earlier, pay to play. And that for as long as in many MLMs and in my own casework, distributors are rewarded for their personal consumption or the volume of their personal consumption, meaning personal purchases, that is the core of the problem, in my opinion.
Yeah, if I could follow on that too, it just seems to me there should be two reasons why someone buys a product. Either they want to consume it themselves or they want to sell it. What happens with MLMs is most of the compensation plans, and I'll say all of the compensation plans that I've ever looked at, create inventory purchase qualifications, so that even though you're not required as a distributor to buy anything, in effect you are, because the only way you can qualify to earn commissions or to maintain your position or rise up in rank is by accounting for a certain amount of volume. So now those compensation plans have created another incentive to buy products, and it becomes devilishly difficult to distinguish, well, is this person buying because they want it, or are they buying because they want to meet their qualifications? And they may have initially bought it to meet their qualifications. Then they realize that things weren't going the way they wanted to, but now they're stuck with this product, and then they start consuming it themselves. So how do you categorize that? Initial decision was to meet your qualifications, but now it becomes you're using it yourself. I think if you were able to eliminate the inventory purchase qualifications from these compensation plans, I think you'd solve a lot of problems. Of course, you'd create problems for the companies, because I think the artificial demand is what props up a lot of these companies. But
and Claudia, you had a point there, just I suppose to finish off for us.
Yeah, precisely. So that it's artificial consumption. And this is the point of our model, to say there are so many reasons why people buy that you cannot really distinguish between a technical wish to consume or original wish to consume. They are under the pressure to buy for many reasons. And I just want to show a color table that I did not show. Here is a comparison between the reasons why distributors buy and employees. And there's one reason which is identical in MLMs and employee discount outside. And this is that they get a discount. And all the other conditions about which I talked, they are different in MLMs from non-MLMs. Yeah, so it's really this set of things that goes together that makes people buy. And it's hard to say whether, yeah, which is the core reason or whether products are consumed.
Thank you so much, Claudia. And I'll hand it back over to our Master of Ceremonies, Bill, to lead us into the next